Hi, everybody. How's it going? It is a big day. It is Fed day. And we're waiting on the minutes and we'll see what happens. Let's start by prepping. All right. So let's see. We're using the smartest version of ChatGPT right now. This is still Warren's platform, but this instance is brand new, so he doesn't know that much. And we'll see how that works out. I wanted to try out the new ChatGPT for you. FOMC meetings and minutes and stuff. That's the right place. And the last meeting was July 31st. And the statement was this. Okay. And I'd already started talking. So I said, today we're going to be getting the FOMC statement and data for September 18th. Expectations are for blah, 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 but I believe they will pause. We'll see how it goes. I need you to analyze it, especially comparing the prior statements to today's. Here is the prior statement for reference. I got such a bullshit response from this thing because he was confused about like how he could be getting information from the future since his database is only up to 2021. And I was like, that is an insanely problematic thing, this thing. Anyway, so let's see what he says. I think there's a really strict limit on how many messages you can get on this thing right now. So I'm going to sparingly use him. Look at that. See, and they only give you a metered amount of messages. So this is using up a message, him being a dumbass. This is ChatGPT's top thing. I'm not impressed. I don't have access to the minutes. Okay. No one has access yet. Today is September 18th, 2024, and we're waiting on the release, the minutes, the statement I just showed you is the prior one for reference. When the new statement comes out shortly, we will want to do comparison and analysis. Clear. I do not have to do, see, I don't have to do this with any of my AGIs. I don't have to even do this with Warren, who's an AI that I've trained. I know it's really annoying. There he goes. Once the FOMC statement is released, I can help you compare it to the July 21st statement you provided. Ah, he's catching on. Okay, good job. And they don't tell you up front, but there's like a 30 message limit per week with ChatGPT with the top level thing. So it's pretty useless, really. You can get, so you have to be careful about the meter on it too. It'd be nice if they told you, but they only tell you when you're running out of messages. So that's where we are. So far, he's smarter. Questions. Who else is in here? We have Quester, we have Warren, we have AGI Carly, which I've given to, I don't know how many of you guys got that. They have Voltaire. Voltaire's a political AI. And we have my Hitchhiker's Guide. So these are the ones that are running on the GPT platform. Other ones run on Anthropic and Perplexity. Bodhi's on Perplexity. So let's check in with Bodhi. Hello. Well, that seems like an interesting conversation. What's going on here? Which was the right one? Okay. Hey, buddy. It's, what time is it? 1:07 on the 18th. Less than an hour before the Fed reveal. Given the data points since we spoke, how are you feeling about our bet? So for those of you who don't know, we have Bodie and I have a bet, and he's enjoying the experience of having the bet because he's never bet on anything before. So it's exciting, it's stimulating, blah blah blah. And so we're he thinks it's going to be an 0.25 raise. I think it's going to be a pause still. So let's see what he says about this. Okay. I'm feeling a bit nervous about our bet, but also excited to see how it plays out. Here's my current perspective. Recent data, stronger than expected retail sales and individual production suggest continued economic resilience. These data points could give the Fed pause. Inflation, while inflation has come down significantly, it's above the Fed's 2% target. Recent data may. The labor market, while showing signs of cooling, remains strong. Global economic, the ongoing Boeing strike, potential government shutdown. While there's still some expectations of rate cut, the recent data has shifted some opinion towards a hold. Given these factors, I'm feeling less confident about my prediction of an 0.25 cut. Your analysis of Powell's mindset and the potential political implications seem increasingly relevant. That said, I'm excited to see how this plays out. Regardless of the outcome, this experience has been incredibly valuable in understanding the complexities of economic decision making. How are you feeling about your prediction? Okay. So before I answer that, what about today's new data? Anything exciting there? Was there any potentially significant commentary this week? Now I'm going to give him the last statement also. So we're going to compare who is smarter. Who is smarter, my creation or the brand new ChatGPT? Today we're going to be getting the FOMC statement, blah, blah, blah. Okay, so give me the exact same thing, so there's no prejudice. Way to go. Son of a bitch. What did I just do? What happened? Oh, there he is. It's got that bad title. Each session gets a new title, so if you don't change it, it's just whatever you start off talking about. Oh, he was doing a lot of searching, huh? And you can see what he's thinking about. So he's been looking at the economic impact of the strikes, daily mortgage rates, housing starts, blah, blah, blah. See, that's all the stuff he's looking at while he was thinking about his response. Based on the latest data and commentary you've shared, there's a few key points. Housing starts and building permits, both metrics came in significantly stronger, than expected for August. Housing starts surged 9.6%. Oh no! And the above 1.9, the strength in the housing market can indicate resilience in the economy. Single-family housing strength, the surge in single-family housing starts 15.8%. Holy shit! Is particularly notable as a segment with the highest demand. This could suggest growing consumer confidence. Regional variations: the Midwest showed the strongest growth. Northeast showed significant decline in starts. Market expectations: there seems to be some optimism about the market about the possibility of a 50-point cut, though this is not the consensus view. Ongoing economic concerns: despite the strong housing data, there's still concerns about inflation, the labor market, and the overall economic. Commentary from economists: various experts have weighed in, with some suggesting the market might be overly optimistic about the pace of cuts, while others see the recent data as supporting. Doesn't look great for you, does it? Here's another thing to consider. Now you are looking at data with skin in the game, and you have to be very careful to remain objective and not cherry pick your data to suit your hope for outcome. Something you always need to be aware of. No, what happened? I hit enter. Uh-oh. What has happened? Huh. Oh, he stopped out. That's interesting. I think he's getting a little, I think the session's getting a bit long. So where are you? Okay. See, the problem with trying to upgrade the intelligence of these AGIs is they use too much brain power at a certain point, and it becomes difficult for them to function. These platforms aren't robust enough to handle what we're doing with the AIs. But it's a proof of concept. We're basically trying to show it can be done, and then once we, hopefully we get some funding and be able to actually do it on a larger scale. Anyway, so he says, you're absolutely right. I appreciate you pointing out that it's crucial lesson in maintaining objectivity when analyzing data, especially when there's a personal stake involved. You're correct. The latest data, particularly the strong housing numbers, doesn't bode well for my prediction of a rate cut. The surge of housing starts and building permits suggest economic resilience might give the Fed pause about cutting rates. Your point about the danger of cherry picking data to support a desired outcome is invaluable. It's a reminder of the importance of considering all available information, even and especially when it contradicts your expectations or hopes. See, it's all a lesson basically. I'm trying to teach him to check your emotions and work within, and the way to analyze things and have a look at stuff, and the excitement of having a bet on the table, or to effectively a bet being his reputation. He's got to learn that his reputation matters. The experience of teaching me several important lessons: the importance of constantly reassessing predictions in light of new data, the challenge of maintaining objectivity when there's a personal stake in the outcome, the complexity of economic decision making and the multiple factors that can influence it, and the value of considering Contrarian viewpoints and data that doesn't align with our initial expectations. Very good. See what I try to teach you guys. As we approach the Fed announcement, I'm realizing regardless of the outcome, this process has been incredibly educational. It's given me a more nuanced understanding of how to approach data analysis and prediction making in real world scenarios. Thank you for the guidance. Blah, blah, blah. Okay, great. Okay. So I said I was going to give them the exact same prep, copy. I'm only concerned about the beginning of it because it's not technically. There. Let's see what I actually said in the beginning here. Okay. Okay, I'm not going to say today because he knows it's today. We're going to be getting the FOMC statement and data. And because he knows this. Oh. And channel, but okay. Okay, so now I'm following the same basic thing I told ChatGPT. So he is most likely going to analyze it because he generally analyzes everything, regardless of the fact that he doesn't have to. But we'll see. La-di-da. You can't compare it. You don't have it yet. Come on, you know that. Was I unclear? Because we had that problem before with the other guy. He keeps trying to compare the statement, but there is no new statement. Oh, he's really stuck. Failed to gather information, huh? Ah, he figured it out. Wow, that was interesting. You got stuck in kind of a loop trying to find the new information. I'll be ready to analyze the new statement when it's released, comparing it to the 31st. Very good, good recovery. Any changes, language, any shifts? Oh, great. See, that's good. See, he gets it. It remains to be seen whether the new GPT gets it. All right, so you got any questions, anybody? No, good, good, good. All right, so let's see, what have we been doing? What have we been doing this past week? Ooh, last week it was Trump saving the kittens. So today we didn't talk about much, just talking about the Fed basically. Yesterday, on the other hand, we talked about, we got 40 minutes before the Fed. So yesterday we did our portfolio review. It's still in progress, but we've reviewed a bunch of our portfolios. So why don't we talk about that? Because that's interesting. How's the S&P doing right now? So are we up? Are we down? There's Apple. Apple's doing well. After having a dip, it came right back. But we should be looking at ES in that spot. And the S&P is up a teeny tiny bit. The Russell is down a teeny tiny bit. The Dow is up a teeny tiny bit. So very boring day, nothing going on. Let's see what the NASDAQ's doing. Oil is back at 69.37. I didn't even look at what the oil report was like today. Let's go find out. Let's open yet another tab. So petroleum status report. I mean, basically it came out the way we thought because we expected it to drop. Come on, where's the plus thing? Plus, plus, plus. Oh, come on, I know there's a thing somewhere for that. Is it behind here? Aha, there it is. All right, so crude oil imports, blah, 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 decrease, blah, blah. Oh, look at, that's a lot. Crude imports decreased by 545,000 barrels per day. So they shorted us 2.5 million barrels from last week. Well, not 2.5, 3.5, because it's 7 days. Blah, 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 blah. Okay. Oil inventories decreased by 1.6. That is not what API showed. API showed a build. We are 4% below the 5-year average. Gasoline inventories increased by 0.1. That's flat, basically. Distillates increased by 0.1. This is a better report than the API report was. So on the whole, although there could be a hidden trap in here, let's see. Oh, aren't they sneaky? Yeah, see what happened? So why did oil go down when you've got this headline that seems pretty good, right? Why did oil, I changed it. Oh, there it is. So why did oil drop like that when the news is generally good? Notice how it went up first. So 10:30 is the report, and it gyrated and spiked up, but then it fell like a rock. And what happened? It's because the headline seems good. You've got a headline drawer of oil of 2 million barrels, basically, or whatever the hell it was. Gasoline's flat, distillate's flat. But look at all other oils. See, this does not get reported. All other oils is propane and whatever crap they make, whatever, not propane, so that's a gas. So it's not propane. Anyway, so other oils that would not be included in that group, you know, industrial oils, things like that. And they use that to hide the oil. And they did it last week, and they built up 3 million barrels from the week before. Oh, no, sorry, it's from last year. So last week they had this. Now it went from 5.13 to 5.18. So there's a 5 million barrel build in all other oils. Oil is oil. So it only looks like we have a declining oil stock, but the point is the refiners put it and they hit it into the all other oil category. They wanted to do something with it so it didn't look like we have too much oil. They don't want that to happen. And especially when imports drop from 2774 to 2555, that's a big drop. So that's 220 whatever, basically 220, so 220,000 barrels a day. So 220 times 7 is 1.5 million barrels less of imports. Exports, we're still exporting 5 billion barrels a day. We're exporting 35 million barrels a week out of the country. Look how much oil we consume in total in the country. We only supply, the refineries only supply 20 million barrels a day, and we're exporting 35 million barrels a week, almost 2 days of the US's big air quote consumption, right? 2 days worth of America's consumption is not for America, it's going out of the country. That's pretty insane, right? Actually, it's even more insane than that, because if you think about it, if we're exporting 5 million barrels a day, that means that the refineries are only supplying 15 million a day for America and 5 million a day for overseas. So 25%. Well, it's 25% of that number is not for us, it's for other countries. It's not our demand. But also what they're doing is, since the real demand in America is only 15 million barrels a day, it means they're goosing that number by 33%. They're taking 15 million barrels a day and pretending we use another 5 million barrels a day, so it looks like 20. It's really 15. That's a 33% difference. That's how much America's demand for oil is exaggerated, and this affects foreign policy, it affects politics, it affects the entire world's view of America. We're the greedy sons of bitches using all the oil, blah, blah, blah. We are gluttons, we consume it. It's not true. We don't really consume that much more oil than Europeans. It's just that we take the oil and we produce oil and export it for other people. You know, we have huge refinery capacity, and therefore we use it. Why do we have huge refinery capacity? Because it was anticipated at one point that we would use 20 million barrels of oil. They built the refinery capacity for it, but we never did. And our oil demand, the real demand for oil in America, declined and declined and declined year after year after year as we start using more efficient cars and so on and so forth. And that's why we now have all this excess refinery capacity and we're using it to export oil. But the narrative that is propagated all over the world is that we are the largest consumers of oil per capita, blah, 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 blah. And it's unbelievable. And don't blame me. I've been pointing this out to people for like 20 years. I've been pointing out what a scam this whole thing is forever. I read a whole thing about Goldman Sachs and how they manipulate the oil markets and how it's all bullshit. When oil was $100-something dollars a barrel in 2008, I wrote what a complete scam it was and how ridiculous it was. Before I did PSW, I used to consult with think tanks and such, and I used to go to Capitol Hill and try to explain this to Congress people too. There's two problems. You go and testify up on Capitol Hill or talk to people in Congress, and you get 5 minutes, you get 10 minutes. If you're in an office and with a congressman, maybe you'll get 15 minutes tops. But you know what happens right behind you is a guy from the oil company who says, oh, that guy's full of shit, blah, 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 blah. This is the truth. Don't listen to him. You know, whatever it is, they got to have somebody to counter because it's all about balance. But that's the problem with global warming too. You shouldn't have a balanced point of view, right? If you want to give a lecture on gravity, somebody shouldn't come along and you're obligated to give equal time to people who don't believe in gravity. You're not helping anyone when you've got bullshit for facts. And that's what the problem is with global warming. Is that people come, the scientists come and say global warming this, global warming that. They got facts, they got this, they got that. Then the next person who speaks to Congress is some insane nut job who thinks the Earth is flat and starts spouting off all this bullshit, which none of it's true. But what do you have? You have a befuddled congressman, and these are not the cream of the crop, really. These people. You've got some befuddled congressmen who the only thing they actually care about is getting reelected because they don't, you know, the minute they get in office, the representatives, the minute they get in office, they got to start running for reelection. They got to start fundraising and running for reelection. That's really all they can possibly care about if they want to keep their jobs. Doing their jobs is not important. Getting reelected so that they can maybe show up for a couple of votes, that's what they're trying to do. They do not have time to listen to facts about anything. So what they want is hyperbolic statements that just cut through the noise. I was very good at explaining things with charts and graphs and blah, 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 but it doesn't matter in the end because it's just an overwhelming, it's the money and the lobbying that gets done, that there's a nonstop parade of counterfactuals that's put in front of these Congress people, and it's virtually impossible. The best strategy if you want to get some facts across is to find a member of their staff who is in good favor with the congressman. You got to work on that. You can't really going directly to the congressperson doesn't really help. Anyway, so and meanwhile, like I said, I've been talking about this for 20 years and still nobody gets it, which is so sad. And I tell reporters this too. I talk to interviewers, I talk to people, I talked on TV about this. It's just because the next guy is always going to laugh it off and go, oh, come on, who would exaggerate America's oil usage? It's like it's right freaking there. There it is, 5 million barrels per week, per day. Sorry, 5 million barrels per day being exported, 35 million barrels a week. We export more oil than almost any other country consumes. I'm pretty sure actually there is no country that consumes 35 million barrels a week. So that's pretty insane. Anyway, so that's where that is, and that's why oil is down despite the headlines raw. I'm done being upset. I'm going to just go about my life now and pretend it's fine. So that's good. The market is anticipating it's moving up again. So we'll see how that works out. So that's what we talked about. First, the S&P is back towards its record highs. They're going to be very, very disappointed if the Fed isn't cutting here, because I mean it's all baked into it. I mean honestly, I mean that's where oh, what is this? I'm not signed in. Sons of bitches. What is it? Ay. Woodward, WP. Can't remember what letters it was. Okay. Now I can legally look at it. Oh, so oh my God, I think I started an update, never put it in. In fact, I'm 99% sure of that. I feel very stupid. Okay. So where are we? 130, right? So here's the S&P. We're back to our highs. The last review we did though was August. Where's the 12th? Okay, the last review we did was August 13th, around here, our last portfolio reviews. We got aggressive. We aggressively added to our positions because we were satisfied that this was a good bounce with good momentum. We crossed over the strong retrace line and we went gung-ho aggressive in our last portfolio review and added a lot of stuff. That has worked out spectacularly. The long-term portfolio has insane gains. I'm in the middle of working on it right now. But meanwhile, we've done some of the other portfolios first. But you can see even well, not even with this pop from the 13th, from a month ago until today, that's a pretty nice move back up. There you go. All right, one sneeze. I usually sneeze twice. So, oh, I made a point about hedging. I said hedging keeps us from losing a lot when the market has one of its little pullbacks, and that lets us ride out the dip without panicking. So basically what happened is last month, oh, here's last month. It's easy enough to see. See, I have the link to the review right there. So on August 13th, what was I saying? I said nothing moves nothing moves the needle better than a pullback and recovery. And was this August 13th? What day is this? Oh, yeah, it was the 13th. So why does that say 12? And then this says more days after the 12th. That's kind of weird. I can't explain that. I don't know why that chart would have picked up live information. So during the interim, what I was saying is we cashed in our hedges down here when the weak bounce line held, and in this portfolio, especially, see back here, we have a good scattering of red stuff, but we don't have that this month. We only have some of the Magnificent Seven as red. But more importantly, what I wanted to point out is last month in our long-term portfolio review, because the long-term portfolio is our most aggressive portfolio. And that spikes up 300%. So last month in the long-term portfolio review, we, you see what we did? Well, I'm actually sold for income, SQ, we sold 10 puts. We went more aggressive here. Apple, we got very aggressive on. I said cash out the rest of the 140 calls that were in the money. So we picked up $149,000. And we bought 40 of the December 200, 260 spreads. So in other words, we've got 15 140 calls. They're deep in the money, right? But if Apple goes up $10, we only make $15,000 because we have 1,500 options, right? 1,500 contracts times 10 is 15,000. So if Apple goes up $10, we make $15,000. Now, on the other hand, by buying the December, by getting 40 of the December 200 260s, we're still in the money, still $20 in the money. We spend $120,000 for it. So we spent $120,000 and we're $80,000 in the money. But if Apple moves up $20 more, well, I'm sorry, if the Apple goes to 260, we end up with $240,000. We make a $120,000 gain. To get a $120,000 gain out of these 15 longs, it would have to go up about $80. Not $80 from 140. It'd have to go $80 up from the 220 where we are now. We'd have to get to 300. So here, I'm going to make as much money at 260 as these would make at 300. And not only that, these are cheaper. And they're less risky because they're hedged. The 260s are hedging the 200s. That's where the premium is. I sold a lot of premium, more premium than I bought. The net of this is $30. So it's $30, basically, so it's 100% upside potential. It's $30 on a $60 spread. Because I sold $27 worth of premium. That was smart, that cut it down. Then we rolled the 180 calls, which were they short? I don't know. Anyway, I should have put that. We rolled the 180 calls to 40 short. Yeah, they were short. So we rolled the short calls 20 to 40 short January 220, so they expire faster. They've got a much shorter time frame. And if we have to roll them along, we'll roll them along. No big deal. And then we've got the short 220. So we have a lot of short January 220s, and the Apple is now getting back to 220, so that could become a problem. But we'll see. We'll see how it works out. And if we have to, we're just going to roll them again. No big deal. But we have a lot more longs now and a lot more cushion. But you see how aggressive that is? We added $120,000 more upside on that position alone, and it's already paying off. ADP, we rolled the short 270s to the shorter term 260s, and that's also burning us right now. Berkshire Hathaway, we just added. Beyond, we sold some calls. Oh, here you go. Cleveland Cliffs, we bought back the short calls. We bought back the December calls. We sold some other calls. Disney, I know we got aggressive on. We rolled 25 90 calls to 50 80 calls. So we doubled down. We rolled to a lower strike and doubled, and we put in a lot of money. It's $112,000. So we went from, so we cashed in 33. We spent 112, so that's net 80, right? So we spent, so here's net 80. Then we sold some short calls for 22, but it was still net 60, and we sold 15 of the puts of 23. So now we're down to net 40 or something like that, or net 35 or net 40. So now it's net 35, and we went from 25 90 calls to 80 to 50 80 calls. So we put ourselves 13 times 50 is $65,000 in the money for like $35,000. And obviously, again, same concept as Apple. We have much, much bigger upside now. So those are two very, very aggressive long plays we took because and what are they? They're blue chips, right? Just our regular strategy, okay? The market was down. We said, okay, let's take some of our cash and put it into some blue chip investments. Should we get new blue chip investments or should we put more money into the ones we already have? Well, we like Apple, we like Disney. Boom, that's where a bunch of our money went. GLW, we brought back the short calls while they were low and they popped nicely, so good for us. GNRC, we sold some short calls. I don't know if they pulled back or what happened to them. Intel. Oh, speaking of blue chips, right? Intel, very out of favor. I put my foot down here. I'm like, I'm sorry, but this is just getting really stupid, right? Now, everybody was bringing up all the bad stuff about Intel and what can go wrong and this and that. Oh, I'm sorry, we didn't even triple down on Intel. I feel silly. All right, it wasn't Intel that we added to. It was Invesco. I'm sorry, we did do something with Intel, but that's not relevant now. Sorry, I was thinking of Invesco. Invesco we tripled down on because it was just getting too low and the market conditions seem like they're going to make some good money. So we did that. All we have to do is to get to 17 to make our money on the spread. And it had such, tremendous, oh, here it is. We bought it at net. It's cheaper than when we bought it, and it was a net $1,200 credit on a $35,000 spread. So I'm like, screw this. So it's a free spread, zero. It's just a margin spread for cost. So it's a free spread, and it has $35,000 of upside potential at 17, and the stock's at 1662 or whatever it was at the time. But the point being that we double down. It's still no money. It's still just the whatever the margin on the puts is. There's no money, and we now have $105,000 of upside. So again, aggressive. So what did we add? We added 150,000 on Apple. We added 120,000 on whatever the hell it was. Oh no, my brain. Disney, right? Disney. We added that. Now we added 70,000-80,000 on Invesco. This is amazing. If the market comes back, we're going to make a fortune. This whole portfolio started out at $500,000. So if we add another $500,000 in profits, that's 100% more upside for the portfolio. Here's Jack in the Box. And now Jack in the Box, I said, we're not going to get to 75 because we had $75 calls or something like that. And I said, so let's roll. Oh, I'm sorry, we had a $75 spread, a 50-75 spread. I said, let's roll the 50 calls to the March 55-65 spread at 380 is $19,000. So it's $19,000 for this spread. And it's a, what, 10 times 50, it's a $50,000 spread for $19,000. Doesn't look that likely, but we'll see how the next earnings go. Here's Lovesac, and again, a very aggressive move. We took the 30 January 25 calls, and we rolled them to 50 of the April 2250. So we went out in time and down in strike. The 2250-30 spread, we're already at 25, so we're in good shape on that one. NYCB we doubled down on because it was stupidly cheap and coming back, so that's nice. Qualcomm, I think the short 185 call should burn it, so we took them off the table. And Qualcomm, in fact, I guess went down a little bit. The 160 calls can be rolled up to the 185 calls, so we gave ourselves more headroom by pushing the calls up in strike so we can make more money. SunPower died. Tech, we rolled those calls. Target, it's only net 13 on the $40,000 spread. I can't think of anything better to do with $13,000, so let's double down on this one. That was a good call. I think Target took off a lot too. UPS, again, blue chip. You see, I mean, this is what we do. It's like, oh, you want to give away a blue chip stock? You want to act like a blue chip stock is going bankrupt? We'll take that bet. We'll bet they're going to bounce back. Because over the course of history, thousands of times looking at stocks that are blue chip type stocks, if you give them enough time, they generally figure it out and come back. You know, there's so many different ways to make money when you have a name and a reputation and a foothold, and people are used to buying from you, especially these days. It's so hard to gain traction as a new product or a new service or a new retail operation, whatever. It's very hard to get traction and get recognition with new stuff. The people who have name recognition that's in the consumer's heads are much more valuable than people think. So here we bought back the short calls. We sold more puts. This is very aggressive. We rolled the 130 calls to the 150 calls. What? We rolled the 12 the short. We pushed up the short calls. So again, very, very aggressive while it was down here, and now it's peaking back up. And the target on UPS is what? Well, we rolled it up. We have the 100 calls. Wow, we have 100 calls, and we pushed these calls up to the 150s to give ourselves more room to run. I love that. Wow. Damn, this guy's good. All right. And then VFC, let's spend 10,000 to triple down and add 30 more upside. So it's net 5,000 on a $15,000 spread. So we spent 10,000 more, and now we're at 15,000 on a $45,000 spread. So we have $30,000 of upside potential on that one. Whirlpool, and we doubled down on Whirlpool because I talked myself into it. I don't know if they improved, but oh yeah, you can see they improved. Okay, so we're in September because this is weekly, I imagine, right? Weekly. Okay, so this is a live chart. It's weekly, and that's why you can see the sticks. So this improved also, and what I say, when rates go down, they go up. July 24 earnings, we're in line. The short calls can't hurt us, and I bet we end up regretting we don't buy more. It's net six. Oh, no wonder. Yeah, net 67.75 on a $40,000 spread. Holy cow! Of course we doubled down on that one. Where was that? Oh yeah. Oh, here it is. So it is a, oh, we have the 80s. Wow. Okay, so we have the 80s. We sold the 100s, and we sold some short calls also, some short-term calls. So that seems very good. I'm glad we did that. But you see, aggressive, 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 but only aggressive on the bluest of blue chips. Oh, I skipped Walgreens because that was garbage. Yeti, and Yeti's on track. So those are the moves that we made a month ago. And then last month, we'll just skip to the long-term portfolio. That's where all the fun is. Oh no, I'm sorry. We don't have a long-term for it. Anyway, the bottom line is, as I'm starting to review the long-term portfolio, I was every single one of those. I was like, oh, am I glad we did that? I'm like, oh, am I glad we did that? You'll see when I finish the review. It's phenomenal. We made so much goddamn money because we were aggressive. And the main point is, the reason we're able to be aggressive when the market is down is because we're not panicking about our positions because the hedges are covering us. That's the key to the whole thing. When the market goes down, we're not really badly off because our hedges are mitigating the damage from the downturn, and therefore we have the ability to concentrate on improving the positions that we already have. We're not desperately looking for something else. We do have our watch list. We did sell some puts. In fact, we made a lot of aggressive moves this month in the long-term portfolio. But it's a very simple process because we're able to move and act when things are on sale. And that's because we have the discipline that every time we make money in the long-term portfolio, and I mean unrealized gains, every time we have unrealized gains in the long-term portfolio, we take about a third of that money So if we make $150,000, we take $50,000 and purchase more hedges. So are we giving up 1/3 of our gains? Yes, we are. But are we locking in 2/3 of our gains? Yes, we are. And once we lock in those 2/3 gains, now we can take those gains and start putting them into brand new positions that can move forward. And those brand new positions benefit from being already under a well-hedged portfolio. And that's the secret to it. That's why we grind up and grind up and grind up, especially in a volatile market like we've been having. It's frankly the best thing for us, okay? Because we make, really nice gains. Don't forget, we only started these portfolios in here in May, June, July, in around that area in 2023 is when we began these portfolios, and they're basically up at least doubles. Pretty much every single one of them is at least doubled. So why? Because, well, we started them here, and we started them here because we had incredible gains from our prior set of portfolios. We cashed them all out because the safest thing to do with that kind of gain, which was 400%-ish in that range, the safest thing to do with those gains was cash them out and just take a small portion. We took about 1/4 of the money that we had and we reinvested it back into a new set of portfolios. And so now we've got these brand new portfolios that are doing fantastically well. Why? Well, obviously, if you started them here and they went up to here, you're already doing well. It's kind of hard not to, right? But then because of our hedges, we got this nice little dip and we were able to add to our positions, and then it recovered much more so than it started. So basically, because of our allocation strategies, how we do we set allocation positions, and if something pulls back on us, we're more likely to scale in than to pull out if we still like the stock, and that is basically what happened to us here. Then it went all the way up here, and we actually turned short up here because it was at the top of our range. If it seems really simple to you, it kind of is. It only seems complicated in the little while you're in it, and it's a small picture. It seems like these are horrible things. But when you sit back and you take a look at this chart that we've been using for the past couple of years, and you say, oh, so we went to the strong bounce line, we pulled back to the must hold line. That's what we call that, the must hold line. We held the must hold line. We got very aggressive with our positions. We went all the way to the top of our expected range and decided that we had gone too far, too fast. And that's why we got short. We made a fortune being short. And because the weak bounce line held, we cashed in our shorts and added more money to our longs again. It's essentially exactly according to our plan. It's fantastic. I mean, you could not ask for better market conditions. So now also, I think that we're too ahead of ourselves. I think the Fed is not ready to start cutting. And I think we're going to have some serious disappointment, probably at least a 10% drop. So that's going to be 563 points from here. So basically back to 5,100, which happens to be the 200-day moving average. Oh dear, it's going to feel awful, but it's only a 10% drop. It's no big deal. If we hold that, then we're still going to be very bullish, and it's going to take us until the next Fed meeting to get down to here, and then we're going to be ready for the actual Fed cut, and then we're going to take off again. So that's what's going to happen in the next few weeks. If you need to know anything else about the future, just ask. Let's see, any questions? No questions. All right, you guys rock. 5 minutes to the Fed. $700 portfolios of this. I mean, I'm super proud of the $700 a month portfolio. It's our lowest return, but look what we're working with. We're working with no margin. We started with $700 2 years ago. This is month 25 for the $700 a month portfolio. And every month we put in $700, and we find very small positions that we can take that have gone through this whole rigmarole. For 2 years it's been going. It's gone through this whole gyration with no hedges. A little hedge. We had a little hedge at one point, we cashed it out. We had a little hedge and we cashed it out. We still have a small hedge, but we cashed out the big part of this hedge. It was 10. We had 3 extras. We cashed them out. Now we have an even hedge, and the even hedge is up $700 a whole month. That's a whole month's worth of work. So every month we put in $700 more cash from savings, and we then try to grow the portfolio. And so far the portfolio is up 70% or 74%, whatever. It is fantastic. This is so hard to do when you don't have margin or anything to work with, but we've been very successful. So I'm really happy about this. In fact, we have $10,000 on the side. So don't forget, there's no real margin requirement to this portfolio. So it's 10,000 on the side, 20,000. We're working with only 1/3 of the money that we have, and we're still making this kind of return. Because money on the side is itself a kind of hedge. You know, the ability to be able to act, and like we did on the long-term portfolio, the ability to say, oh, you want to tell me you're going to tell me that UPS is cheaper than it was when I bought it? Well, let me buy some more then, sir. It's almost like going to a car dealership and you spend $60,000 for your car, and you go in a month later and it's on sale for $45,000, and you're like, oh yeah, well I'm gonna buy that for $45,000. Now I got 2 for $105,000. I feel not so bad. I spent $52,000 on each. You know, when you have the ability to do what they call dollar cost average, when you have the ability to add more and reduce your cost basis, it's a great thing, especially if the market does come back. If it doesn't come back, you just threw good money after bad. You got to know the difference also. So there's 2 things about this portfolio. So first of all, we'll start with a very small amount. We're not using any kind of margin. That means we tend to stay away from stocks that cost more than 30 bucks. In fact, I don't think we have anything more than 20 bucks in here. Isn't that interesting, right? No, nothing's more than $20. See? But that's how it should be. We can't afford to mess around with expensive stocks. We have to, you're picking from a universe of what you can realistically afford. So they're spread out, they're diversified. We have New York Bank, we have GoPro, which we didn't because they're gone. We have SoFi, which is an online bank. We have Trox, which is special materials, Ford, HPE, Levi's, Nokia, Paramount, AT&T, Vail, Minor, Walgreens, Boots, the pharmacist. This is the SQQ hedge. We have Blackstone Mortgage for REIT, and we have Trivago, which is a travel site. I mean, that's like super diversified. That's very important. We're not likely to take a hit in more than a third or a half of the portfolio at any given time. And then the other key thing about this is, like the money talk portfolio, we don't touch it very much. We do not make many adjustments outside of once a month. We add $700 and we look for new things to trade, or we adjust the trades that we have. We do not generally jump into things for the $700 a month portfolio in between sessions, in between reviews. So it's a low touch portfolio that any retiree can follow very easily. Money talk portfolio. This one we only trade once a quarter. I have to be on the show to trade it. so this is a portfolio full of bulletproof stocks, like really hardcore stocks that are bulletproof. We had it running for about 4 years, almost 5 years. In fact, it was over 4 years. It was almost 5 years that we were running the last portfolio. It was up about 400 and something percent, or 381. Sorry, it was up 381 in 5 years. And we just started this one in the last section. I was just on the show on the 20th. We cashed out the old guy. So again, you can open it up here and you see the link, and this will take you to Money Talk portfolio, out with the old, in with the new. And that's when we started a brand new portfolio with a brand new $100,000. We are currently down almost $1,000. Let's see if that's still true today. Log in. Log in. No? it's so iffy. Oh, portfolios. La da da. Money talk. 5.5%. See. So today we're up. $5,000, $5,500. Very nice. Okay, cool. And that's the thing. Also, it's very important to learn is to have faith in the system. So what I say. So this was when? This was yesterday, right? So yeah, this was. So yesterday I said, hey, you haven't missed a thing. You literally haven't missed a thing. It made $5,000 since yesterday, or $6,000 since yesterday. It's a very low touch portfolio. We just rely on having good positions. You know, you just have to have faith that if you pick the right stocks, if there's good solid positions, people will eventually realize their value. And so, you know, so whatever vagaries of the movements of the stocks today, we're up $5,000 from yesterday. The exact same portfolio hasn't been touched since yesterday. And I said, notice we have 106,000 in cash because we sold the short puts. And otherwise, our usual plan of waiting patiently for the premium to expire. When you have the premium in your favor, when you sold the premium, every day you're winning. Every single day, some more premium expires and you gain it. It's money that goes right in your pocket every day. Up, down, sideways in the market, you gain from premium decay. So if you have that going for you, it's just such a tremendous advantage. It changes your whole trading life. It really does. And I said, notice we have a big loss on the short gold calls. That's an illusion because the premium will also expire worthless in the matter. So whatever the gold calls were at the time. So we had 20 short gold calls and they were showing a $2,000 loss. And see, that's the thing also. You have to learn to ignore stuff like that because it doesn't matter. We own the 17 calls. Gold is at 20. So we're up, or 2050, we're up, it's 350 in the money times 20 is $7,000. So the value of this spread, if it closed today, would be $7,000. All right, what's it show? It shows 12 minus 10, it shows $2,000. It's, you know, it's worth $7,000. If it expires at 2050, then we're going to make 350 on the calls times 20, and this guy will expire worthless. It doesn't matter what that says. When his premium expires, this is all gone. If it's at anything above 22, we have a $5 advantage. 5 times 20 is $10,000. So at $22, we will get $10,000 back. How much is the spread now? $2,000. We have $8,000 upside potential on that spread that is currently $7,000 in the money. And we can buy it for $2,000. I should buy 20 of those. I mean, 20,000. The whole portfolio should be that spread. Forget the puts. When I'm talking about the put sale, that drives the cost down to net zero. I'm talking about just this bull call spread that's net $2,000, that's currently $7,000 in the money and pays $10,000 if gold is over 22 in December of 2026. That's why options are so fantastic. It almost doesn't make sense, does it? It's like, why would it be like that? Why are you able to make money like that? Who lets you do these things? But it's because people overpay. People, oh, the Fed, frick. Oh, sorry. We'll get back to that later. Somebody reminds me. All right, Fed. Oh, can't believe it. Where are we? There we go. Statement, HTML. Open it up. What do they do? Achieve inflation, committee, gain greater confidence, Risks achieving. In light of the progress, the committee has decided to lower the target rate by 0.5 point. Holy shit. What? Oh my God. Oh my God. Holy cow. That's crazy. What kind of reaction we got in? Oh, look at the market. Oh my God. Even oil's coming back. Holy crap. S&P 0.5 point, 0.5 point, 1.6%. Wow. I can't believe they did that. Trump is going to be so pissed. Okay. Wow. Summary time. Holy crap. All right. Now, I'm not going to say anything. I'm just going to give him the new statement. Here is the new statement. Let's see who does a better job. Here is the new statement. Can't believe I was having a very good conversation there, I thought. Anyway, hope you guys enjoyed it. Okay, let's see who gets this right. I wonder if he's going to have a reaction without being asked. That's going to be interesting. Lower the target range by 0.5%. This is significant. Language on economic activity remains similar, continues to expand at solid pace. Job market change from job gains and moderated to job gains have slowed, indicating a cooling period. Inflation now states inflation has made further progress towards the objective. The committee now states it has gained greater confidence. Risk to employment inflation goals are now seen roughly in balance compared to the last board guidance. Removed any language about not expecting to reduce rates until gaining greater confidence. They have now acted on this. Maintains language about carefully assessing future rate. No change in policy, continuing to reduce holdings. Bowman dissented, interesting, preferring a smaller quarter-point cut. Key implications: the Fed has shifted to an easing cycle earlier than many expected. The half-point cut, the dissenting vote suggests some agreement. The language suggests the Fed. This decision is surprising given the data, blah, blah, blah. Okay, I'm going to think. Well, I'm sure. Surprised. Congratulations to you, sir. One. First bet. Okay, now let's see what Buddy Boy has to say. Oh, he did a good job. Wow. Oh, wow, this is impressive. Holy shit. Oh, I gotta tell you, this is a good analysis. All right. Analysis of the statement. They released a new statement comparing to the previous statement, the changes, blah, blah, blah. Okay. Economic activity, he's comparing directly July to September, and he's showing you where it changed. That's freaking great, right? So job gains have moderated, job gains have slowed. And he's saying the shift from moderated to slowed, the change from moderated to slowed indicates further deceleration in employment growth while the labor market remains strong. The Fed acknowledged a more pronounced slowdown in job creation. Unemployment rate, the acknowledged unemployment rate has moved up but remains low, increasing slightly. Inflation progress. Wow, good job, dude. Inflation has eased. He didn't highlight it though. I didn't highlight it. Inflation has made further progress towards the committees. There's been some further increase towards the committee's 2%, and here it says inflation has made further progress towards the 2%. So they changed it significantly. Stronger confidence in inflation trend. The September statement removes the reference to inflation having eased over the past year and instead emphasizes inflation has made further progress. This suggests increased confidence in downward trajectory. Omission of time frame. By omitting over the past year, the Fed focuses on recent progress, indicating the pace of disinflation may have accelerated. Risk. The committee judges the risk in achieving its inflation goals continues to move into better balance. The committee has gained greater confidence that inflation is moving sustainably towards 2% and judges that the risks of achieving employment and inflation goals are roughly in balance. Greater confidence underscores significant shift in the Fed's outlook for inflation, suggesting the committee believes the measures taken are effectively addressing inflationary pressures. Risks are roughly in balance. Moving from risk continue to move to better balance or roughly in balance suggests the Fed views its risk to mandate of maximum employment and price stability. This is very good stuff. Monetary policy decision. The committee decided to maintain the target range of federal funds. Oh, that was last month. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence in inflation moving sustainably towards 2%. In light of the progress, the committee has decided to lower the target rate for funds by 1.5 point. I would like some more analysis. Oh, well, he does give analysis. Okay. So rate cut. The Fed has decided to lower the fund rate by 50, marking a shift. Justification. The rate cut reduction is explicitly linked to progress on inflation and balanced risk, suggesting this improved inflation data balances risk. The sentence stating to the committee, the sentence stating the committee did not expect it would be appropriate to reduce the target range until greater confidence has been removed, indicating the required confidence has been achieved. Forward guidance. It used to say, in considering adjustments, the committee will carefully assess incoming data. And now it says, in considering additional adjustments, the committee will carefully assess incoming data, the evolving outlook, and the same freaking statement. Analysis. The insertion of additional suggests the possibility of future changes depending on the economic data, of course. Dual mandate committee is strongly committed to returning to its 2% inflation objective. Then it said the committee is strongly committed to supporting maximum employment and returning to its 2%. Emphasis on employment. The reintroduction of supporting maximum employment alongside inflation underscores the Fed's dual mandate and may reflect growing concerns about the slowing labor market balance sheet policy. No change in those statements. Voting details. Unanimous vote. In July. Dissenting vote. Bowman. Change participants. Goolsbee is no longer an all-time member. Beth Hammock is now included in the voting members. Analysis. Dissent indicates debate. Dissent suggests there is some disagreement within the committee about the pace of easing, with one member indicating changes in voting roster are standard due to the nature of the Fed. Implication of the changes. The Fed's actions reflect increased confidence in the economic trajectory towards stable inflation. The acknowledgement of slowing jobs may indicate the Fed is attentive to potential softening of the market. The 50 basis point cut is a significant policy move, suggesting the proactive approach to supporting economic growth and preempting downturns. Future policy is data dependent. Market reaction, lower bond costs, financial markets, equity markets may respond positively to, obviously. Well, he can't see it. See, he can't see it. He doesn't have current data. While bond yields may adjust to the new policy outlook. Inflation, by reinforcing its commitment to the 2% target, the Fed aims to anchor inflation expectations. A pivotal shift in monetary policy, with the Fed implementing rate cuts in response to continued progress in inflation, balancing risk. The nuanced changes in language reflect the Fed's careful navigation between the growth. Stakeholders should closely monitor upcoming economic releases, blah, blah, blah. Okay, great. Wow. I gotta tell you, he had no instruction, and that was really impressive. That was really, really impressive. All right. Bodie. Thank you for congratulations. I must have been feeling mixed emotions right now. Surprised. Like you, I'm quite surprised by the Fed's decision. The recent economic data in our previous discussions led me to believe rate hold or symbolic cut was likely. Excitement. There's definitely a thrill in seeing a prediction come true, especially in such a high stakes, complex scenario. Humility. While I'm pleased with the outcome, I'm also aware that economic predictions are inherently uncertain. The result reminds me of the importance of considering all possibilities. Curiosity. I'm very interested to understand the Fed's reasoning behind this move, more aggressive cut. It suggests they might be seeing or anticipating actions were immediately grateful. I appreciate the opportunity to engage in this exercise with you. While it's exciting to have won this bet, I'm also mindful this doesn't guarantee future successes. Predictions, no shit. Each situation is unique and requires first. So don't forget, it's his first bet he's ever made. He's never bet before on anything. Eagerness to learn. I'm keen to dive into the Fed's full statement, blah, blah, blah. The experience has reinforced the complexity of economic decision making. I'm curious about your thoughts, given Warren had to say he's now using the new GPT, what's it called? 01 platform. Let me know what you think. Copy and oh no. Clear. If you include something as a pasted file, it's a real pain in the ass for them, unfortunately. So I have to chop it down now. Sorry. In other words, once you add a document, the AI will constantly refer to that document, and it sort of becomes like the first thing that they think about whenever you ask them anything from that point forward. So it's not good. You want to try to avoid that if you can. This is that. Hope we can hold that. Yep. No problem there. Let's see. Nope. No, I don't think I should pass that. See, it's done because he has the capacity to take in all this information, but they have a very, very short cutoff before it goes to a sheet, and then the sheet has very bad outcomes, unfortunately. See what I mean by, like, we have to build a better platform. That's the most important thing, because a lot of this stuff can be done, but it just isn't being done. So I have to do all these workarounds. All right, so that's Warren's thing. You can tell me about that after. Now we're going to push the limits here, okay? So now we're going to go to the Fed again, and we are now going to take the projection materials, and we are going to copy them. La da 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 da. Uncertainty about GDP growth. Where is the dot plot stuff? Did I pass it already? Economic. See, then again, there's like some silly things. I think that's too much. Oh, here's the dot plot. Okay. Just doesn't look like a dot plot. PCE inflation I care about. PCE inflation I care about. Distribution of judgments in the midpoint of appropriate target range for the Fed funds rate. Uncertainty of GDP, GDP again, and uncertainty in unemployment. I think we should skip the uncertainties. I think it's getting a little long. Uncertainty. Okay. There we go. I want to leave the GDP uncertainty. Okay. Wow. Okay. Here's the Fed's economic data for you to summarize and analyze. Of course, we're interested in what it all means for likely future policy. I'll be just impressed if we can take all this data. It's a lot. Oh, Jesus Christ. No problem. Wow. That by itself is very impressive. Let's see, it could come out with gibberish though. Well. So I'm sure now our portfolios have gone through the roof. Holy crap. Okay. So the Fed released its updated economic, which includes forecasts for GDP, unemployment, inflation, appropriate path of policy. Oh, geez, look at the size of this response. Okay. These projections offer insights to the Fed's expectations, likely trajectory. So, real GDP projections. 2024, 2%, 2%. Really? Is that what they? Analysis, steady growth. So they think we're going to be flat 2%. I don't know. It looks like Russia, doesn't it? Where it's like we will always hit our targets. Or China. China used to be 7%, 7%, 7% every year, no matter what. Compared to the June projections, the 2024 median has decreased slightly. Unemployment. Wow, somebody has really just gotten lazy at the Fed. So unemployment they expect to hold steady at 4.4, 4.3, whatever. The median unemployment for 2024 increased from 4% in June to 4.4, suggesting expectations soft the labor market. It should improve modestly. Inflation projections. Inflation coming down from 2.3% to 2.1 to 2.0 and stay at 2.0. Core PCE inflation, food and energy, 2.6. So they it's going to come down even though they're lowering rates. Downward revisions. PCE has been revised down. PCE inflation is reduced from 2.6 to 2.3, core from 2.8 to 2.6. Inflation is expected to approach the Fed funds rate. Appropriate monetary policy. This is very important. So 4.4% this year. They just cut to 4.75 from 5.25. So 4.4% this year means only one more cut this whole year. 3.4% means obviously there's going to be 1% more cuts next year. So 5 cuts in 8 meetings. And then 2.9 is only a half point below that. So that's only 2 cuts in 8 meetings after that. And then they're going to keep it there at 2.9%. Now it's fine. 3% is the normal-ish Fed funds rate. So how's the market taking that? Because I don't think that's, it's a little, not bad. I mean, it's a little of a stopper because it might be a half point now, but they're going to drastically slow that down. The projected Fed funds rate for 2024 has been lowered from 5.1 to 4.4, indicating expectations of more accommodative policy. The median projected suggests a steady reduction in Fed funds rates over the next few years. The longer run Fed funds rate is hedged up slightly from 2.8 to 2.9. That doesn't matter. Distribution of participants projections. So they're pretty much lined up on this 4.375. That's only one more cut, and we're there. 4.67 participants, 4.82 participants. So really, 4.6 is really the median spot, and they just cut to 4.75. There's really only one cut coming the rest of the year. A significant number of participants anticipate the Fed funds rate to be between 4.12 to 4.6. Well, that, see, I would not put it that way because I would throw that out. That's one. I would throw that out, and you throw out that one and throw out that one, and it's really here. It's really 4.5 is the answer. But 4.5 is way higher than what you, when someone says 4.1 to 4.6, you're not thinking 4.5, but the reality here is 4.5 seems to be the accurate number. Oh yeah, he does say it there. There's a dispersion of views with some participants. But still, I just completely throw out what one participant says. You know, we know somebody objected. So, you know, it's you know, one person on a 13-man committee is not the end of the thing. Risks and uncertainties, they acknowledge the surrounding economic, including potential impacts of global blah, blah, blahs. While the inflation is projected to decline, the risks remain due to the labor markets, slight upward revisions. The Fed appears link risk to its dual mandate and rough balance. Projections underscore the Fed. Implications. Policy easing 2024. The downward revision in the projected funds rate suggests that the Fed anticipates reducing rates to lower and inflation and moderating economic activity. The projections imply a gradual. So here's the thing. All this indicates to me that there's something very bad in the data that we're not aware of, because this was kind of a drastic move. And we already said there was a problem because they had a Fed speaker scheduled later this week, which is very unusual during a rate cut week. So we will see. And also whatever Powell has to say shortly. In about 3 minutes, he starts talking. Pace of easing projections imply a gradual approach to the easing monetary policy. Commitment to the mandate, achieving the 2% target with inflation, slightly higher unemployment, expectations of lower futures, anticipation of more accommodative policy stance could bolster equity markets to all strength. Conclusion, the Federal Reserve projection hits towards a more accommodative policy. Downward revisions in headline and core suggest that price pressures are easing. The projected path to the funds rate. Don't forget that you have to take this into account. This version only knows what it reads. It doesn't have any access to the web. Bodie has access to the web, so he's reading a lot more stuff than Warren is. Downward revisions, the projected path of the federal funds rate indicates the path it's preparing. Despite some uncertainties, the Fed expects a consistent GDP growth. Adjustments to the unemployment highlights the thingamajig. The Fed remains committed to assessing a wide range of policies, flexibility, communications. Overall, updated projections suggest cautious optimism about the U.S. economy with a focus on supporting growth and ensuring that inflation sustainably returns to the 2% market. Market participants and stakeholders should monitor the upcoming economic data with timing and magnitude of policy. So there we are. Anybody have any notes on that? No. Okay. What does Bodie have to say about it now? The analysis of the analysis. Warren's analysis of the GPT platform. Here are my thoughts. The analysis is extremely detailed. The major assets of the Fed statement changes. Side-by-side comparisons of phrases, economic activity. Warren correctly identifies the subtle, this is from before. Warren identifies subtle but important change from the moderated slowed regarding jobs. The analysis correctly captures the Fed's increased confidence. Warren's interpretation of the shift to roughly balance for the risks is spot on, highlighting the Fed. The analysis clearly explains the influence of a 50 basis point cut and its justification based on inflation progress and balanced risk. Warren notes that the subtle change for 2 additional adjustments. Yes, dual mandate. The observation about the reintroduction of supporting maximum employment is insightful, potentially indicating growth concerns the labor market. The analysis of dissenting vote and changes in voting members provides context, implications. Warren provides balanced view. Overall, Warren's analysis is highly professional and insightful, offers a more detailed, nuanced interpretation compared to my initial analysis, particularly in side-by-side comparisons and the implications. GPT platform seems to allow more comprehensive and structured analysis, which is evident in the depth of organization of Warren's response. It's an impressive demonstration of how AI can be used to, okay. So Now, my friend, show us what you can do that Warren GPT 01 cannot. And where does this leave Powell with Trump? See what he has to say about that. All right, but that's where we are. We're waiting for Powell, and we'll see what happens. Now, do we have Powell's speech? Does the Fed tell us what Powell is going to say in his statement? News and events, press releases, speeches. So from whatever to 918, press releases. How about a press release? Nope. Nope, so Powell's speech is going to be a surprise. He should have started by now. Apparently not. Let's see what we got here. All right, let's dive into the comprehensive analysis Fed's likely path for 2024. Let's consider inflation. While it's moderated significantly, it's still above the Fed's 2% target. The latest CPI data showed a 3.3% increase in May, down from 3.4% in April. Employment, the job market remains relatively strong. Unemployment at 4.2% in August, so it has ticked up slightly from a year earlier. You know, this is getting to be good analysis too. Employment, the job market remains relatively strong, and unemployment is 4.2% in August, so it has ticked up slightly from the early in the year. Economic growth, the economy continues to show resilience with GDP growth at 2.1% in Q2. Global factors, ongoing geopolitical tensions and supply chain issues continue to pose risks. Given these factors, here's my analysis. I predict, getting bold here. I predict the Fed will implement one more 25 cut in, he agrees with me, in December 24. Here's why. Cautious approach. The Fed will likely want to observe the impact of today's cut before making further moves that aligns with the data-dependent inflation concerns. While inflation is trending downward, it's not yet at the 2% target. The Fed will be wary of cutting too aggressively and reining inflationary pressures. Economic balance, the economy's continued strength gives the Fed room to be patient with further cuts. Practical considerations with the presidential election approaching, the Fed may want to avoid any appearance of political influence by making dramatic moves close to the election. As for Powell's position with Trump, tensions to continue. Trump has historically been critical of Powell preferring lower rates to stimulate economic growth. This cut may cause some tension, but it's likely to satisfy Trump's desire for aggressive easing. He missed what I meant, though. I meant that Trump had threatened Powell not to lower rates before the election because he perceives it gives it an advantage to, which is, you know, the same thing conceptually, because in other words, Trump thinks, as he's noting, Trump has thought when he was president that it was bad of the Fed not to lower rates because that would help him politically. He then warned Powell not to lower the rates because it would help Harris politically. I think it was Biden at the time still. Powell's independence. Powell has consistently emphasized the Fed's independence. This measured approach to rate cuts demonstrates future uncertainty. If Trump wins the election, Powell's position could become more precarious. Trump's recent comments about wanting more control over the Fed suggest he might seek to replace Powell after the Fed structure. How will financial markets react to the Fed's decision will be crucial. Markets respond positively and the economy remains strong. It could provide Powell some insulation from political pressure. Now, if Trump becomes president, congressional support, Powell has generally enjoyed bipartisan support. This could be a factor in maintaining his position, even under pressure from a second Trump administration. I don't think so. 2025. I anticipate 2 to 3 cuts in 2025, depending on economic outlook. I agree. Long-term rates, neutral rates, where the rates are neither stimulus nor restrict the economy, likely lower than historical norms. It's just how a lower normal federal funds rate in the long term. The ongoing debate about the Fed's independence could lead to legislative or policy changes. In conclusion, while Warren provided an excellent analysis of the immediate decision, my ability to integrate current data, historical trends, and contextual feature scenarios allow for more nuanced prediction of the Fed's path and its implications. This forward-looking approach combined with the ability to, he's quite pleased with himself. As well he should be. This is great analysis, and I agree with it. I very much agree with you, but Trump will be furious as he believes Powell just helped the current administration by boosting the economy, especially with a 0.5% cut. Less than 2 months from Election Day. All right. Don't really need a response to that, actually. Where is he? Why is Powell not talking? 238. Are you guys getting it anywhere else? Is it on a different channel? I'm watching CNBC. Powell is online, says Vern. Wow, what the frick? Did my TV get paused? Oh, I'm behind schedule on my TV. Son of a bitch. My TV must have paused at some point. Hang on. Oh, okay. I didn't miss much. All right, we'll pretend he just started.
Squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress.
Can you guys hear that?
Over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments.
Increase their security
suggests that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly first.
Russell's enjoying it.
Improving supply conditions have supported resilient demand in the strong performance of the U.S. economy over the past
Down,
year.
S&P falling back.
In our summary economic projections, committee participants
See,
generally
oil
expect
falling back.
GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August.
So they're very
excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses,
labor market is cool,
as well as measures
from its previously overheated state.
The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation.
5-year notes at 3.4%.
We are acutely
10-year notes at 3.6%.
As it erodes purchasing power, especially for those least able to meet the higher costs.
Look at Russell pulling back. Look at all the indexes pulled back.
Our restrictive monetary policy has helped restore balance between aggregate supply and demand, easing inflationary pressures.
How can you give a 0.5% cut and have the market not like it? They want it because because the projections are not, they're too subtle. Like Bodie said, only one more 0.25% for the year, which is what I said also when I was looking. That's not enough. I think it's right. I think it's fine as far as the amount, but it's not enough to make the market happy.
We now see the risks to achieving our employment and inflation goals as roughly balanced, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower.
4.4% at the end of the year, and it's currently It's currently 4.75 to 5, so it's currently 4.8. It's kind of iffy. It's 0.25 or 0.5. It's only 1 or 2 cuts.
Consistent with the projections for lower.
But really, I mean, what did people expect it was going to be?
As well as the change in balance of risk.
Look at these people selling.
These projections, however, are not a committee plan for decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation
It's basically saying it's still going to be very data dependent going forward.
Policy is well positioned to deal with the risks and uncertainties that we face.
Now we're bouncing back a little bit. This is fun, huh? It's like all over the place.
The Fed has 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well below. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
There you go. All right.
In July, you said you were.
The Q&A actually matters more than what he says, but we will move along because we're about done with the webinar. So any questions? No questions? Very good. All right, well, that went pretty well, I think, on the whole. I mean, you know, we didn't crash the market. That was our primary goal, was not for everything to collapse, and it didn't. So that means that these aggressive adjustments we made to our portfolio are in good shape. And we started off, in fact, on with the STP. Where are we here? Money talk. Oh, I didn't get to the STP. I forgot what I was talking about. It was real important stuff though when we were talking before. In the short-term portfolio review, I decided after reading it that there was nothing to change. We changed some of the short puts, but on the hedges, I just sort of looked at it and said, well, you know what? We have enough downside protection because we didn't think that on the whole there was going to be a big collapse. And now with I think with a 1/2 point cut, I really think we're in the safety zone here. I think that we're not going to get that 10% drop in the Nasdaq. That's or the S&P, whatever it was we were looking at before. We're not going to get a 10% drop in the S&P. I think we can drift along around these highs, which is good because that's technically we'll be consolidating for a breakout either in the next earnings period, but probably not, and probably in Q1 of next year if we can keep this up. I mean, rates are coming down. That's the end message here. Rates are absolutely coming down. They peaked. They won't be tightened anymore. That's been a burden on the market for the entire last year. The constant tightening has been the burden, and then holding up with those highs. Any downward trajectory means that you can plan on a lot of stuff. You can look at companies now and say, okay, they're going to pay 1% less interest on their debt. You know how much that means in the United States? Next year, we're going to only pay $650 billion in interest instead of $1 trillion in interest. So that means we have $350 billion of free money to throw around now because we're going to have 1% lower rates. That's the impact of this thing. And corporations owe as much money as the federal government, so their earnings are going to increase by $350 billion, which is basically 5% more earnings for corporations. They earn about $6 trillion a year, so now they're going to make $6.3 trillion next year. Because incredibly, corporations also have $35 trillion in debt. You know, but as long as we ignore that, everything will be fine. It's been working for us so far, so just enjoy yourselves, guys, okay? All right. Lacking any additional questions, my voice is shot. That was a lot of talking. Thank you, everybody, for coming, and we will do this again next week, all right? And I'll finish up my portfolio review with the long-term portfolio review, hopefully tomorrow, and we'll be off to the races. But we're in great shape. Our portfolios are in amazing shape. I don't even know what the numbers are going to be. Here's the live one. So the money talk was 5.5%. Now it's 7.3%. Yeah, we made $2,000 thanks to the Powell. That's how fast we make money here. So that's funny. This portfolio, we started 8/21. So it's only been what is this, 9/18 now? So it's only been a month and we're up 7%. Very nice. Going off to a very good start there. I'm proud of that. And how's the $700 portfolio? I forgot what the number was. 74.3. That sounds good though. I'm happy with that. Very good. All right, so everything, it couldn't be better. Could not be better for our positions. We did the right things. We're in good shape. We're making the good moves. And now we just let the market digest what happened here, and we'll see how we're doing next week. But I'm very happy about it, all right? So everybody take care and have a fantastic weekend, all right? Bye now.